A very good evening to all the members present here. I welcome you all to this webinar on taxation of charitable trust. We have among us Chairman of DTC Direct Tax Committee, CA Piyush Sohanlalji Chhajed. Sir, Piyush sir is an experienced chartered accountant. He has 25 years of experience in direct taxations. He is a senior partner of Mr. Chhajed and Doshi. He is based out of Mumbai and he is a second time Central Council member. And this time he is a very good evening to chairing all the members present tax committee. Chairman sir, I would request you to have your welcome note.
Thank you. Thank you very much, Vinodji. A very good evening to all of you. The most respected, honorable past president of our institute, CA Manoj Fadnis sir from Indore. Thank you, sir, very much for joining and blessing the Direct Tax Committee, sir. Of course, everybody knows that he's a past president. He was a past president of CAPA. But most importantly, for Direct Tax Committee, he was also the past chairman of the Direct Tax Committee when it used to be Fiscal Laws Committee. Thank you very much, Manoj sir, for joining, sir, and addressing the members on a very important topic, sir. My vice chairman, C. Vishnu Agarwal, who has been a great support in all the initiatives of Direct Tax Committees. And if you see that the guidance note, which was released on 31st July, it was actually under the leadership of the vice chairman, who had actually taken up, formed the group, said to it that each group give its suggestions, and in a most timely manner, 2 months before the tax audit date is going to end, that is 30th September, we could come with this revised publication, which is a very important publication, which is revised after 2 years, and it takes into the consideration two revision of Form 3CD, which has happened. Most importantly, it also tries to cover clause 22, which is in regard to 43B sub clause H. You may know that we did had come with a implementation guide last year, but as you all know, implementation guide is recommendatory in nature when compared to a guidance note, which may sound like a recommendatory, but it is a mandatory in nature, and all the members are expected to comply with that. In case you are not complying, kindly document that what are the alternate audit procedures which you have followed. That's what the pedestal at which the guidance note issued by the Institute of Chartered Accountants of India plays. Vinod Agarwalji, who would be moderating this session, thank you very much for joining. And very esteemed members of our institute, once again, I welcome you for this Thursday seminar on a very important topic, which is taxation of charitable and religious trust. We all know since 2021, we have been seeing a lot of amendments in this space. And a lot of representations are being made by the institute since 2021. And what feedback which we always get is that, yes, we do know, they do recognize that, yes, taxation of charitable and religious trusts is not now anymore simplified. Audit report is not anymore simplified. It has become a complicated over a period of time. It has become a tough. And to support our members, at least in discharging the assurance function, that is audit of 10B and 10BB, last year we came with a guidance note. Once again, as I requested earlier for the guidance note on tax audit, please do comply with that guidance note. Please do consider that, because it will help you in discharging your assurance function. It will ring fence you if you are put to a question as to whether you were negligent or not while discharging this assurance function. So that guidance note was issued in 2024. There's no amendment been made, and that remains valid till the time it is further amended by the institute. Please do follow. But yes, those changes which are happening, we are trying to make a representations. Even in the income tax bill also, there were certain changes when compared to Income Tax Act 1961 and the new bill which has been presented on 2 days before. Even that, there are certain changes when compared to Income Tax Act 1961. We would be making a representation for that also. But obviously, the income tax bill does considers more than 90 suggestions up till now, past president sir, which were given by the Direct Tax Committee. And by compiling those suggestions, obviously, we got views from you also. Thank you very much. And other 40 members group was formed, headed by Vishnu Agarwalji, my vice chairman also, and other council members also. And all those suggestions have been considered very well. Select committee was also quite proactive on that. And even after our first suggestions were received, we got it to know that out of, supposing there were 10 or 11 suggestions which were not accepted. So in second round, we again made a presentation. We wrote a letter, and out of that also certain more than 50% suggestions were accepted. So in all, what I'm trying to say is the select committee, or for that matter, Ministry of Finance, has actually taken up this income tax bill in a consultative method, whereby they have consulted various stakeholders, and therefore, of course, there may be views that why this income tax bill, new income tax act, was required. But I always feel it's an honest effort which has been made for simplifying the tax law, making it more concise, trying to reduce litigation prone sections, or making amendments into that. I'm sure, of course, time will tell how it goes ahead. But from the institute's perspective, yes, Ministry of Finance as well as Select Committee has been quite receptive to our suggestions. That's what I would like to tell the members also. So with this, without taking much time, thank you very much once again to Manoj Fadnis, sir, especially for gracing this Direct Tax Committee webinar, sir. Thank you very much. We shall remain always obliged for that. Vinodji, over to you.
Thank you, Chairman sir. Thank you for your welcome note. Now it's time to hear from our Vice Chairman, Direct Tax Committee, CA Vishnu Agrawal, Kumar Agrawal sir, another seasoned person in the Central Council, having a vast experience in direct tax related matters. He also belongs to Mumbai, the place from where Piyush sir belongs. So Mumbai probably has a good say in direct tax committee, I suppose. Good representation. Anyways, currently Vishnu sir is serving two committees. He's vice chairman of the CP committee and vice chairman of the direct tax committee. Also, he is into various committees. He is serving various committees like standing committee, executive committee, management committee, and finance committee of ICI. So it is it is now up to Vishnu sir. Sir, please give your introductory, that means remark.
Thank you,
on this.
Vinodji. Thank you, Vinodji. Very most respected, our own past president, Sri Manoj Fadnis, and Direct Tax Committee Chairman, Piyush Chhajerji, Nagpur Managing Committee Branch Member, Vinod Agrawalji. First, I thanks to our past president. So immediately accept our invitation to guide all the members on the most important subject on the charitable trust, taxation of the religious and charitable trust under the Income Tax Act. From last 3 to 4 years, each and every chartered accountant, because in India, we have seen that so many trusts, either in the family trust, religious trust, several type of the education trust, several type of the trusts are there. So many litigations are the pendings. Sometimes, when in 2021, the new section has amended for the charitable trust. Sometimes some members have filled up the alternate form, which was not required to fill the form. Those 1,000 types of the problems faced by our members. And today we have with us Sri Manoj Fadnis ji. He's the expert, and I can say he's the most respected in the field of the direct tax. So we thought that we invite our past president, sir, for benefit of all the members. As apprised by our direct tax committee chairman, Piyush Chhajerji, my elder brother, for revised guidance note 44AB. And friends, yesterday only, with the worthy hand of our President Sri Charanjot Singh Nandaji, we have again released the ITR 1 and ITR 4 checklist for benefit of all the members. And remaining ITR checklist, we will release within the 10 to 15 days, which are the under preparation. President sir, past president sir, we have yesterday only we have released the checklist for ITR 1 and ITR 4 for the benefit of all the members, because so many changes this year we have done, CBTD has done. And friends, our new finance bill 2025, as our chairman has said, that more than 90 suggestions is accepted by the select committee, which is already accepted by the parliament, Rajya Sabha and Lok Sabha both. So I will not take much of the time. And only one most important, that under the our council has changes up to if any more than 2 or 3 partnership, any partnership firm, they can sign the tax audit report on behalf of the another partner. For example, in any chartered accountant firm, there are 4 partners. Only one partner can sign the 240 tax audit report on behalf of another 3 partners. From next year, any partner cannot sign any tax audit report on behalf of the another partner. It means individual capacity of the one partner, he can sign only 60 tax audit report. So there is changes. So I request each and every member, please keep this in the mind. And without wasting of the time, I request Vinodji to introduce our past president, Sri Manoj Padnesji. Thank you, sir.
Dear members, it is my privilege to introduce to a personality that doesn't need any introduction as such. Our beloved past president, CA Manoj Fadnis sir, an experienced chartered accountant for more than 35 years, 38 years. And I understand one thing: when you are served as a president of our esteemed organization, that means you have those all qualities that are beyond exception. I mean, you have the leadership, you have the technical knowledge, and you have an exemplary leadership to lead your profession. So Manoj sir, as you all know, has been president of ICI in the year for the year 15-16. He was also president of CAPA, Confederation of Asian and Pacific Accountants, for 2 years, for the years 15 and 16. He has recently been nominated by Honorable Supreme Court on an ad hoc committee to manage the affairs of an educational institute having nearly 2,000 students. He has served as National Treasurer of Lokmata Ahilya Devi Tri Shatabdi Samaroh Samiti. He has he is currently serving on the board of Federal Bank as independent director, and he is chairman of the audit committee there. He has been on the board of the State Bank of India. He has also been a member on the standing committee of Insurance Regulatory Development Authority of India, and he has also served as non-executive chairman of MP Stock Exchange from 2012 to 2014. Sir, this much accomplishment are too much to, I mean, describe. We have lot many accomplishment of his in the profile, but since I have been requested to shorten, I'll end my introduction here. Over to Manoj sir. We welcome you, sir.
So before past president sir, I also welcome Krutika ji, who is also our co-opted member of expert advisory committee, and she's contributing a lot. Welcome to you, Krutika ji. Also, thank you very much, Krutika Fadnis ji. Thank you.
Thank you so
Yes,
much.
over to you, Fadnis sir.
Thank you. Thank you, Chairman. It is my privilege and honor to be part of this webinar being organized by the Direct Tax Committee. And I'm thankful to the Chairman and the Vice Chairman of the Direct Tax Committee, both very accomplished and very experienced, not only chartered accountants, but also income tax professionals. So it is good to see that the Direct Tax Committee is being headed by such experienced people. And friends, you would have seen the impact of this when the Income Tax Bill 2025, which is presently before the Parliament, the definition of accountant, which is so very important and so very critical to all of us, has not been changed. Although there were very strong and very serious attempts made by other professionals that they should also be allowed to carry out the audits. But thanks to our council, our president, vice president, and exemplarily led by the Direct Tax Committee, the committee could convince the members of parliament that the chartered accountants alone are competent to carry out the audit. And this has been now so stated in so many words by the select committee of Lok Sabha of the parliament, which has recommended the same provisions to continue, and there is no change in that. So friends, while it is a great achievement for the council and the Direct Tax Committee, and on behalf of all of us, we must really thank them. But the right way of thanking our council would be to ensure that we carry out the work of audit in the way and manner in which it is mentioned. As both the chairman and our honorable vice chairman just mentioned, there are guidance notes which are issued by the institute, both for say 44AB, also for the audit of our charitable trusts. Very important guidance which is given in with respect to Form 10B and 10BB, which, as all of us know, are quite complex and tedious at times. But what is really important is that these guidance notes are recommendatory in nature, they are not optional in nature. I think that difference we must always bear in mind. There is no option whether I can follow the guidance note or I cannot follow the guidance note. They are recommendatory in the sense that if for some reasons auditor takes a view that I need not follow the approach given in the guidance note, and there could be a different approach which I can follow, then the auditor is free to follow an alternate approach, provided the auditor documents the reasons for not complying with the requirements of the guidance note. So guidance note in a way is mandatory for us. It is binding on us. And anything that comes from the institute, be it the standards or guidance note, or even the expert advisory committee opinions, or we may have, for example, the ITFG bulletins, and there's so much of literature which is the technical guide, as was mentioned earlier. So as members practicing, we should not get into the arena of whether they are mandatory or not mandatory. The approach that we should follow is that whatever comes from the institute is mandatory. It should be complied with, and that is how the best way we as professionals can serve our country. So, given the fact that there is now an Income Tax Bill 2025, which is going to replace the age-old Income Tax Act 1961, the changes are to, as was so well explained just now, are only to make this implementation of the act more simpler in nature. And the language has been improvised upon. The language is the use of the number of sections and provisos and explanations there too have been removed, so that the sections can be easy to read and easy to understand. And when it is easy to understand, it is easy to implement for the SSEs. So it's a great work done by the CBDT in terms of bringing out this new legislation. Not many changes as such in the fundamental law, but the law is certainly more simple and more easy to read and understand. I'm thankful to the committee for Direct Tax Committee for giving this opportunity to speak on certain matters relating to charitable trusts. Now, taxation of charitable trusts is always uh, is a very interesting subject. The one way which I always feel to describe the charitable trusts is taxation of charitable trusts is that it is far from being charitable so far as the auditors and tax professionals are concerned. My one very sincere suggestion and advice to all the members is that while the trustees are doing a charitable activity, we are engaged by them to carry out a very important professional activity. And therefore, the taxation of charitable trusts is not a matter of charitable activity for the chartered accountants. It is a very important professional activity because if by chance any mistake happens, there will be a lot of losses which will be incurred by a charitable organization. And therefore, it becomes our onerous responsibility in a way to see that the SSE complies with the requirements as they are prescribed for the purposes of taxation and to avail the exemptions which are there so that the income is not subjected to tax. So there are very rigid timelines prescribed, very strict timelines prescribed. In more than one cases, there are uh, powers given to the assessing officers to condone the delay. The law with respect to charitable trusts, which has seen a lot of changes in last 2-3 years, starting from Finance Act 2021 and the Taxation and Other Laws Amendment Act 2020. From that point of time, we have been seeing a lot of very important amendments being made in the law relating to charitable trusts. Very important decisions of the Honorable Supreme Court, landmark decisions of Honorable Supreme Court, which have made us understand their decisions and their earlier decisions in a different limelight. So in the case of noble education, as the Honorable Supreme Court has clarified, that Section 23C(6), which talks about an educational institution solely being an educational institution. So the word solely has been, the way it has been interpreted by the Honorable Supreme Court, to say that solely is not predominantly, but it is in a way exclusively an institution imparting education. And therefore, the rigor of the provisions have become more sharper and in some cases more difficult to comply with. But be that as may, as professionals, as auditors and consultants to the charitable trusts and educational institutions, it is our duty to see that we explain to them the various provisions and help them to comply with the law. I may also mention that while I said at the beginning that we as auditors are, as chartered accountants, are only competent to carry out the audit, I would very respectfully say that we respect all other professionals for their knowledge on tax laws. The various other professionals may be brilliant as far as their understanding of the laws on taxation are concerned, but the exclusivity with the chartered accountants is because of the knowledge of audit. And audit is audit is audit, as we understand. So be it audit of a charitable trust which is smaller in size and the form being issued is simpler as compared to the larger charitable trusts. But that doesn't differentiate between the responsibilities which we undertake. And in that context, we say that the audit should remain with the chartered accountants as being the only profession which is trained in this specific subject of audit. So today, while we discuss these aspects relating to charitable trusts, there are two regimes which are now being brought out. The first regime is what is contained in Section 10 and Clause 23C. And the other regime is with respect to the income which is claimed as exemption under Section 12AA and Section 11 and Section 12, and the registrations under 12AA and 12AB. Now, friends, these two regimes which were there historically had very different provisions, though the income was exempt under both the regimes, and some of the provisions were same, but few provisions were different. Over a period of time, what has been tried to be done by the CBDT, and rightfully so, is to align the provisions of the first regime and the second regime. So wherever there were differences, those differences have been removed. And now, by and large, the provisions contained whether institution is registered under 1023C or is claiming its exemption to be income to be exempt under Section 11, the provisions are by and far same and similar. Now, what is also important is that with the amendment which is made last year by Finance Act of 2024, the second act of 2024, effective from 1st of October 2024, there are not going to be any further registrations under Section 1023C. So the first regime will have a sunset period when the current institutions which are registered under Section 1023C, their registration period expires, they will have to migrate to the second regime. And there will therefore, going forward, be only one regime under which the charitable trusts and educational institutions will be subjected to tax. Now, in some cases, in very few cases, there are still some differences which are there between the provisions of Section 1023C, the first regime, and the provisions contained in the second regime. One such difference is in respect of educational institutions, as I said, 1023C 6 for educational institutions which are registered under 1023C. The requirement is they should be solely for the purposes of education. And the way in the case of Noble Education Institution, the Honorable Supreme Court has explained this. If that institution is carrying on any other activity other than education, it may lose its exemption. Whereas a trust which is carrying on an educational institution registered under Section 12 AB, claiming its income exempt under Section 11, it is carrying on a charitable activity, charitable purposes, which includes education, which includes relief to the poor, and other limbs as defined in Section 2, subsection 15. So therefore, an educational institution which is covered in the second limb has a degree of flexibility available to it as compared to an educational institution covered in the first regime. So these are very few and very, so to say, technical or very fine differences between regime 1 and regime 2. There is also in case of educational institution in clause 1023C4, where an educational institution not having income up to not whose gross receipts are up to 4 crores, up to 5 crores would be exempt from the would have the exemption under clause 4, subclause 4 of 1023C, and therefore the entire income would be exempt. Whereas if an educational institution is registered under, say, 12AB and claiming exemption under Section 11, it would still have to ensure compliance with the other requirements of spending 85% for the purposes of its objects of the trust and the other requirements contained in Section 11, 12, and 13. So, but for these very few differences which still exist, the regime 1 and regime 2, the advantages, disadvantages, or let us say the kind of compliance which is required is more or less the same. And going forward, as I mentioned earlier, the first regime would, so to say, expire, will come to an end, and we will have only the second regime which will continue. No, uh, one very important aspect or one very important development which I would say has happened in the last few years is the application of income. And the way the law has changed over a period of time, it is now ensuring that the application of income comes from income which is earned and which is otherwise to be considered for the purposes of Section 11. Earlier, the importance was on the application, the expenditure, and not from the source from which that expenditure was incurred. So whether the expenditure is incurred out of the corpus or the expenditure is incurred out of borrowings was not really important. What was important is that have you spent the money for the purposes of objects of the trust? And if you have spent the money for the objects of the trust, it doesn't matter if it has come from your corpus or if it has come from loans borrowed or it has come from any other sources. It could even be excess of application or a deficit carried forward from the previous years. Because what has been important is that the law has been set to be with respect to computation of income and not computation of total income. So when you are computing the income, it is the income which is derived in the commercial sense of the word. So how a common prudent businessman will determine the income? He will determine the income by uh, seeing that whatever the income is there and what are the expenses incurred, those expenses would be reduced from the receipts, and that would be the income. Now, it does not matter if the money spent is for a revenue purpose or if the money is spent for a capital purpose. So what is important is that it has been applied towards the objects of the trust. But that all has changed in last few years. And now there are specific provisions brought in the law, which in a way overcome many of the earlier decisions of the courts to the contrary, Now the position is that the money should be spent out of what I have marked in the slide as green. So it should be either a voluntary contribution, because voluntary contribution is also an income for the purposes of Section 11, and income which could be receipts from main objects, receipts from any incidental objects like rent, commission, dividend, interest, agricultural income, net consideration on transfer of a capital asset, or any other such type of income. So you have to look at these sources of income and then look at the application of that income towards the objects of the trust. So if the money is spent out of corpus trust, corpus donations from the corpus of the trust, or it is spent out of surplus of the previous years, it is from loans and borrowings, money borrowed from other sources, or it is just trade payables and other current liabilities, those sources will not be considered when you're determining what is the amount which is applied for the purposes of the objects of the trust. So in a way, what we have is, if a trust is following mercantile system of accounting, while we have Section 145 of the Income Tax Act, which says you follow either cash or mercantile, for the purposes of computation of income, it becomes hybrid. So your income may be computed on an accrual basis, but your expenditure are only on a cash basis. So any amount which is payable will not be allowed as a deduction. So as you know, we make the adjustments for add the opening creditors and reduce the closing creditors to determine what is the actual amount of money which is spent for the purposes of the objects of the trust. So the entire calculations with respect to application, the way it has changed, it has in more than one decided cases of the earlier years have been overcome by these amendments. So for example, there have been well decided case laws that if there is a brought forward loss, that you have spent more money in year one than your income. So you have a deficit which is there in your balance sheet, which you carry forward in the next year. And in the next year, you apply your income less because you have a brought forward deficit to be adjusted. The court said, because the taxation is on the principles of uh, income as determined from the commercial sense, that brought forward deficit would also be considered for the purposes of application in the second year. Now, by way of legislative amendments, that has been done away with, and any brought forward losses, such deficits will not be considered as part of the application of income for the current year. So, as we draw analogy even from Section 14 of the Income Tax Act, now what 14A, what it brings out is that if you have tax-free income and you have taxable income, expenditure which is attributable to the taxable income, only that expenditure would be allowed as a deduction. So if there is an expenditure which is attributable to a tax-free income, that expenditure will not be allowed as a deduction. That is the way we do the calculations also. And now it is very clear that if you have common expenses, then they have to be apportioned as per the rules, as per the formula given in the rules. So only taxable income and the expenditure attributable to the taxable income is what is considered as deduction in the computation of income under the head business and profession. Similarly, for commercial, for the charitable entities, it is income which they have earned and what is the application of that income. So if I have got something as a corpus, and out of the corpus, if I have invested, if I have acquired a capital asset, then that corpus, that capital asset acquired out of corpus will not be considered as an application, because it is as I said now, that it is an income tax act and it is not an expenditure act. So when it is an income tax act, it is the income which is earned and which is applied towards the objects of the trust. That application will be considered in relation to that income. And therefore, the manner in which the income is to be considered has undergone a significant change in last few years. Now, with that, let us look at what are the essential conditions or ingredients for claiming exemption. And these are all instances which are known to all of us. These are very simple provisions under the law. But just to recap, what is considered here is the property from income which is derived should be held under a trust or a legal obligation. So this is the starting point. It should be the income is derived because Section 11(1) says it is the property from income which is derived, which is held under a trust or under a legal obligation. So we are talking about it could be a trust, it could be a society, it could be a company registered under Section 25 or Section 8 of the Act, as the case may be. So these are the kinds of entities to which the income would be considered for exemption under Section 11. Then another important aspect is it should not give any benefit. It should not be meant for any particular religious community or a caste. So it should give benefits to all, and it should not be specifically religious driven or a community or a caste basis type of a entity to which the exemption is available. Now, while there are some very important case laws on this subject, if there are teachings which are being propagated, that may not by itself mean that you are carrying out activities which are meant to benefit a particular religious community. You may be preaching the teachings which are given by a particular community, but that is for the benefit of all. So it should not, so that distinction also needs to be kept in mind, that it is not for benefiting a particular community, but teachings of a particular community, if spread and money spent on that, would be available for exemption if it is for the benefit of all. So that is the important aspect which needs to be borne in mind. Then the trustees or people who are carrying on these activities, they should not be benefited out of the working of the trust. So if there is a trust which is running a hospital, and if one of the trustees is admitted in that hospital, it does not mean that hospital cannot give treatment to that trustee. But what it really means is that whatever is the fees and charges which are payable by any other person is the same amount which should be paid by the trustee or the people, the specified persons. So the trustees themselves should not get any undue advantage, unreasonable advantage by carrying out the activities of the trust. So that is also important to be considered. Then income has to be spent or it has to be applied as per the provisions of Section 11(1), 1A, 1B, 1C, which are important to be borne in mind. It is so earlier it was 75% of the income should have been applied. Now it is 85% of the income which needs to be applied. And also what is important is that the income should be applied for the charitable purposes in India. So if the income is being applied for purposes outside India, then obviously that in that application, that expenditure will not be considered for the purposes of determining what is the amount which has been applied, that for calculating that 85% quantum. So the purpose and its application should be India-centric, unless under 11(1)(c), the Central Board of Direct Taxes has classified certain activities or certain organizations to which can carry out for purposes outside India where India has an interest. So barring that, the general rule is that the expenditure should be for purposes and the expenditure should be for purposes in India. Then funds should be invested in modes specified in Section 11, subsection 5. Now, this is one very important amendment which has been made a few years back, that donations which are received for the corpus must all be invested in the in terms of investments which are prescribed under Section 11(5). So 11(5) prescribes all kinds of post office deposits, bank account deposits, certain types of units, trusts, etc. So there are very specified categories in which the investment needs to be made so that the exemptions are available. Now, what is important is that when this amendment has come in, what would happen if a trust receives, say, a machinery, plant and machinery, a trust is running a hospital, and the hospital gets a plant and machinery as a donation. So that plant and machinery could have been in the earlier times said to be part of the corpus of the trust. Now, what is important is that whatever you get donation as corpus needs to be invested or deposited in the modes prescribed under Section 11, subsection 5. So, with this amendment having been brought in a few years back, it is important to see that the corpus donations are received in such forms which could be invested in the modes prescribed under Section 11.5. And if there are certain, say, equipments, plant and machinery items which are received as donations, it would be good to consider them as voluntary contributions, take them as income, and on the other side, say that you have applied it for the purposes of acquiring a capital asset which is used for the purposes of, which is with respect to the objects of the trust. So as a hospital, I have received a machinery. I should take the value of that machinery as an income, and simultaneously I need to show that income as having been applied towards that capital asset, which is the machine which I have received. And in case I make a mistake in showing it as part of my corpus trust, as a corpus donation, the difficulty would arise with respect to compliance with the requirement of investing that corpus as per modes prescribed under Section 11.5. And if there is a window of 1 year available, if a trust gets a donation and it is in some other form, then within 1 year it has to be converted into, translated into a mode prescribed under Section 11.5. But if you have received plant and machinery which are for the benefit of the patients who are going to be served in that charitable hospital, you will not be converting that plant and machinery, you will not be selling that equipment and converting that money into a deposit. So these are certain finer points which need to be kept in mind. Now, there is a 1982 circular which also says that whatever is the surplus which has been accumulated, that to that extent of 15%, the 85% is spent and 15% is accumulated or set apart. Now, this 15% should also be invested in modes prescribed under Section 11, subsection 5. It is not that this amount is freely available to a society and it can use it for any purpose. The money received, the amount received, 100 rupees, if 100 rupees have been received, 85 rupees need to be spent for the objects of the trust. 15 rupees can be accumulated, can be kept separately, but they cannot be just invested into equity shares or any other places. They also need to go into one of the modes prescribed under Section 11.5. Now, there are certain decisions and very old decisions of the Supreme Court which says that 11.2 accumulations under 11.2 are necessarily guided by the law as per the amendment are the accumulations done under Section 11.2, and we'll come to that later on. They will go into modes prescribed under 11.5. But 11.1a, that 15%, there is no specific requirement to put it into a mode prescribed under 11.5. Now, these could be certain gray areas, but generally I would believe that from the point of view of ensuring compliance and not getting into litigations, it is advisable that the surplus to that extent of 15% should also be invested in a mode specified in Section 11.5. Now, here there is one small difficulty which trusts generally find, and I'll be grateful if the Direct Tax Committee under your leadership, Piyush Bhai, can examine this and see if it is possible to get some benefits to the trusts is that there is no time available for the trust to put that surplus into 11.5. So by the time the trust determines its what is the income, what is the expenses it has incurred, and as we know, there are very detailed calculations to be done, make adjustments for trade payables, ensure that tax is deducted at source, etc., that you find out what is the amount which is applied and what was your income, and therefore what is the surplus available. You have spent 85% of the income, or you are accumulating some part under say 11.2 and carrying it forward for next 5 years. But there is no uh, provision which says that you can invest this surplus or what has been accumulated up to the date of filing of the return of income. So taking a practical scenario, if I have to complete the audit, if a trust has to get its accounts audited by say 30th of September and file its return of income by 31st of October, it would be somewhere in August or September that it will be in a position to crystallize what is the accumulation to be done under 11.2. And that accumulation must go on into a mode prescribed under 11.5. Now, this should have been done before 31st of March. And the benefit of allowing it to be done up to the due date of filing of the return or audit reports is not there. So these are matters which could create difficulties for the charitable trusts to see that they are properly, that the money is not really, the benefit is not lost because the investment under the modes prescribed under 11.5 could not be done. The very fact that the ascertainment of the amount is after the balance sheet date should enable the trust to have time up to filing of returns under section 139(1) or the due date for filing the audit reports, at least up to that date, for ensuring that the surplus is moved into a mode prescribed under 11.5. So maybe this, and there are a few more suggestions which I would be sharing, which may kindly be considered at your level.
Yes, sir.
Yes, sir. Then the trust has to apply for and obtain registrations, which is but obvious. Then it is also required to maintain books of accounts. Now, these books of accounts have been prescribed recently, a few years back, in terms of the powers given under Section 12A 1B, Clause 1 with respect to books, and Clause 2 is with respect to the audit. So there are detailed set of books of accounts which have been prescribed, registers prescribed depending on the types of projects which are being carried out, whether any business activity is being carried out. Then under section 11.4a, as we know, the business should be incidental to the attainment of the main objects of the trust, and separate books of accounts should be maintained for that particular business activity. So maintenance of accounts and the relevant registers and records is very important, and that should be scrupulously followed by the trust. Then the audit reports in Form 10B and 10BB will come to that as we move forward. And also very important that the return of income is filed within the due dates which are prescribed. So a trust to get the benefit of exemption is required to ensure compliance on a very timely basis. And that is where our services as the chartered accountants, as auditors, as consultants would be of great help to the charitable institutions. And it is also for this reason that I mentioned that the trustees are carrying out a charitable activity, but we as auditors are carrying out a very specialized professional activity in terms of guiding them to ensure compliance with the relevant provisions of the Income Tax Act. I may also, by the way, add that one of the very important aspects which is being discussed in the profession today is a decision taken by our Honorable Council, and I fully support that decision that the non-corporate entities should follow the format is the format which we normally use for the financial statements of corporate entities. So it is same as what is there under Schedule 3 to the Companies Act. And it is a very good practice which is being brought in by the council that even non-corporate entities must have certain formats when they prepare their financial statements. Now there is a technical guide. There are FAQs which have been recently issued by the Accounting Standards Board and the Auditing and Assurance Standards Board. And it clarifies that in relation to an educational institution, if or a charitable trust, if there are any formats which are prescribed in the law governing that entity, then those formats under the law must be followed. So, for example, in Maharashtra, there is a Bombay Trust Act which prescribes a particular format. So, trusts which are registered under that act need to ensure their financial statements are in accordance with that particular provisions of law. For all others, there is a technical guide again brought in by the institute a few years ago for not-for-profit organizations. And all educational institutions and charitable trusts will have to comply for their financial statements as per that technical guide. And I would strongly urge friends, while that is not the subject that I'm dealing, but that could be a subject matter for a separate discussion. The accounting and the formats given for not-for-profit organizations also require a proper study by our members, because it looks into what is a fund and a non-fund, restricted funds, general funds, and using that funds analogy, the income and expenditure and balance sheet is required to be drawn up. So a school or a college which has been preparing its income and expenditure account in the normal formats need not follow the format prescribed for the non-corporate entities, but the format which is prescribed for these not-for-profit organizations is also very technical and would require proper study and application of mind to see that the right things are put at the right places. Friends, moving forward in our discussion, it is important to know what is the definition of charitable purpose and how important this definition is. It looks very simple under section 2, subsection 15. Charitable purpose means relief of the poor, education, yoga, medical relief, then preservation of environments and preservations of monuments, which is there, and advancement of other objects of general public utility. Now, this advancement of any other object of general public utility, in a way, has been a subject matter of a lot of litigations and a lot of amendments have taken place. The current position is with respect to this proviso, which says that if a trust is carrying out advancement of other objects of general public utility, it shall not be considered as a charitable purpose if it involves carrying on any activity which is in the nature of trade, commerce, or business, or any activity rendering any services in relation to trade, commerce, or business for a cess or a fee or any other consideration, irrespective of the nature of use or application or retention of that income. So look at all urban development authorities which are functioning in the country. They were the first ones to be hit by these provisions. Although now there are different sections under different other provisions under section 10 where they are eligible to claim deductions. But these kinds of assessees have been generally put to difficulties, or any trade or industry associations have been put to a challenge, in the sense that if their income from these activities exceed 20% of the total income, then that activity is not considered as a charitable purpose. So the proviso, it has been clarified that this proviso will apply only with respect to the last limb and does not really affect the other limbs. So if there is a trust which is carrying on a business activity which is incidental to the attainment of the main objects, in that case, and say it is engaged, it is a hospital. Let us say there is a hospital, which is a trust is running a hospital, and along with the hospital, it has also opened a, say, a pharmacy shop. Now, the business of pharmacy shop is incidental to the attainment of the main objects of the business of running a hospital, and therefore under 11(4)(a) it would be available for exemption, provided it maintains separate set of books of accounts. Now, if the receipts from pharmacy shop exceed 20% of the total receipts of that hospital, then it is still not hit by this proviso, because the trust is carrying on the charitable purpose, which is relief of the poor. It is providing medical relief. So it is a separate limb as far as the definition of charitable purpose is concerned. But if there is a trade association and it is collecting fees, and in the collection of fees, if the fees collected for the services rendered exceed 20% of the total receipts, then then it would be outside the limbs, outside the ambit of the definition of charitable purposes. So this aspect of any trust which is carrying on other objects of general public utility, so that is where one should very carefully see what is the income which is derived from these activities, which are in the nature of any services rendered and any fees collected, as compared to the total receipts. If it is exceeding 20%, then it would be liable for taxation and it would be outside this definition. There has been a very important decision of the Honorable Supreme Court in the case of CIT versus Ahmedabad Urban Development Authority, which came in just less than just 3 years back, somewhere in 2022, end of 2022, and which has really explained at great length the law relating to this particular provisions. It also contained a reference to the matters relating to our institute too, but statutory bodies have been dealt with separately, and urban development authorities have been discussed separately. So this entire concept of general public utility has been very finely discussed and decided by the Honorable Supreme Court in this case of Ahmedabad Urban Development Authority. Now, as explained in this decision and also as explained in the earlier circulars issued by the board, if the fees is received, which is just to recover the cost which is incurred, or maybe it may be a notionally or nominal amount more than the cost which is incurred, then the entity may take a stand that it is not carrying on trade, commerce, or business. The activity is not in the nature of trade, commerce, or business. But if it is making substantial profits and there is no correlation between what you are charging as fees and what is the cost which the entity is incurring, in that case, it could be hit by the provisions of carrying on activity which is in the nature of trade, commerce, or business, and would be hit by the provisions of this proviso to section 215. So what is the cost which is being charged, what is the fees which is being charged, and what is the cost being incurred? I think we as chartered accountants are best equipped to help the trusts to determine what they should be charging and should not get into difficulties on such in relation to such matters. Then, friends, registration of trusts is something which is very time oriented. Strict timelines are there. Originally, it started in 2021, and there was a time period of 3 months which was given. All existing trusts were expected to ensure compliance with the registration before 30th of June 2021. But that was a period when we had COVID in the country, not just in India, but all over the world. It was suffering from the COVID and its after effects. And it was but natural that this date would be extended from time to time. And finally, the deadlines were extended up to 30th of June 2024. And after 2024, 30th June, there has been no extension which has been granted with respect to the timelines. So all trusts which existed before 31st of March 2021 should have and ought to have been re-registered under the new procedures latest by 30th of June 2024. Now, fortunately, they have given powers to principal commissioners and commissioners of income tax to condone the delay. And this has been granted only in last year. Earlier, they did not have powers to grant, they did not have powers to condone the delay. As you would see, the powers to condone the delay are today contained in section 12A. There is a separate registration requirement also given under section 80G. Unfortunately, in 80G, there is no powers which have been granted to the Commissioner Income Tax or Principal Commissioner Income Tax to condone the delay. And unless the CBDT uses its powers under section 119 to extend the timelines as it has done on multiple cases with respect to filing of Form 10 and 10B, the 80G applications are stuck up. And this is another area where I would request the Direct Tax Committee to have a look at the provisions under 80G. And as powers which are granted under Section 12A, similar powers should also be granted to Principal Commissioner Income Tax or Commissioner Income Tax, that on a case-to-case basis, if the trust has genuine reasons for not applying for re-registrations within the prescribed time periods, their delays can be condoned. But this has fortunately been granted in relation to Section 12A, and therefore, if a trust existing on 1st of April 2021, which has not applied for re-registration up to 30th of June 2024, can still try. I said try because it is subject to the powers to grant condonation does not mean that in all cases the CIT would condone the delay. The delay has to be justified. There has to be bona fide reasons for the delay. It cannot be just because somebody forgot and papers were left in the drawers and the accountant was not available. So these may not find favor with the income tax department. And the consequences of failure to get re-registration could be very serious. It could land the trust into a very serious situation where 30% of its accretions will be liable for taxation in the financial year 24-25. So as we carry out the audits and we carry out the compilation of their tax returns, if by chance a trust has failed to re-register within the time allowed, before we complete the audit, we should see that they apply to the CIT or the principal CIT for re-registration and with a strong application for condonation of delay. Now, the first part was trusts which existed on 1st of April 2021, before 1st of April 2021. Then for the new trusts, from 1st April 2021 to 30th September 2023, the law was different, and effective 1st October 2023, the law is different. The initial law, that is from 1st April 2021, any trust established from April 21 to say 30th of September 23, 30th September 2023, or a trust which existed before 1st April 2021, but was not registered with the Income Tax under the Income Tax Act. So for them, they had to apply for a provisional registration. The provisional registration would be granted initially for a period of 3 years, and then they would they have to apply for a fresh registration. The fresh registration was to be done 6 months before the expiry of the provisional registration or within 6 months of commencement of their activities of the trust. Now, this law, while being implemented, created a lot of practical difficulties. The difficulties were that the procedure was cumbersome. So if I am a trust, which I have established myself as a trust and I immediately started my activities, even then the trust had to go through the rigmarole of a provisional registration and a final registration. Second, if I was a trust which was, say, formed 10 years ago, but I had never applied for registration, then there was no way that I could submit my application for registration within 6 months from the commencement of the activities, because my activities have commenced 10 years ago. So these were the difficulties which were being experienced for that period of 2 years and 6 months, from 1st April 21 to 30th September 23. And therefore, this law has again changed after 1st of October 2023. So for trusts which existed on 1st of April 2021, they should have been registered uh, in accordance with the new procedures by the 30th of June 2024. The last and the final extension came in by way of circular number 7 of 2024 dated 25th April 2024. Then the registration certificate is issued in Form 10AC, which is valid for a period of 5 years, starting from the year in which, it is in fact valid from 1st of April 2021, so to say. And re-registration is to be applied for 6 months before the expiry in Form 10EB. So if 6 years are complete, 5 years are completing on 31st of March 2026, friends, you should ensure that the registration application is submitted before 30th of September 2025. So that is the importance of keeping a track of all these due dates. Otherwise, if it is applied after 30th of September, there is already a breach in relation to these provisions. And then you have to go to the CIT and apply for condonation of delay. Now, failure for registration is very serious because this newly enacted Section 115 TD would cast heavy responsibilities on a trust which fails to get itself registered under the entire process. The other aspect here is, once a registration is cancelled, there is no mechanism available for that trust to re-register under the Income Tax Act. And I will also again request our Direct Tax Committee to make a note of this anomaly, because when the law was amended on 1st October 23, the wordings are such that there is a residuary category, any other case, which has not claimed exemption under Section 11 in the past. Now, a trust which was existing, say, from 1st of April 2015, and in 2021, 1st April 2021, it should have applied for registration. Let us say it got itself registered. But for some non-compliance, its registration is cancelled. Say it has failed to invest the money in the modes prescribed under 11.5, or there have been serious violations which are prescribed under the law, which could be curable also. Some of the violations could be cured. It is not that those violations are fatal. So if there are certain violations, and because of those violations, let us say the registration under 12A is cancelled. Now, for this trust to reapply for a registration, there is no procedure available to the best of my knowledge. I have tried to read it several times, but I could not come across enabling provisions where this trust could apply for re-registration. And I believe that the way the law has been amended on 1st October 2023 has left this anomaly, which still needs to be cured, and where our institute can play a pivotal role in seeing that these trusts are getting a proper justice. So with respect to the trusts, the new trusts, that is those trusts which either came into existence after 1st of April 2021 or applied for registration for the first time after 1st of April 2021, they have to apply at least 1 month before the commencement of the previous year. This is the position for the first 2 years and 6 months. Provisional registration granted up to 3 years, and that period was extended up to 30th September 2023. As I mentioned, there were a lot of difficulties One is that the application had to be submitted 1 month in advance, 1 month before the beginning of the previous year. So if my activities, if I am a trust formed, say, in the first year, and I apply for the registration, the registration would be valid from the second year because I have to apply 1 month before the beginning of the financial year. Now, the year in which I'm established, the year has already begun. So there is no way I could have applied for registration before the start of the year. So these were some of the difficulties which were there for these kinds of entities, and therefore the law was amended from 1st of October 23. So now what the law has done is it has put the trusts into two categories. Either the activities have started or if the activities have not started. If the activities have not started, have not commenced, then then the trust can apply for a provisional registration. And if if the activities have started, then it can apply for a regular registration. Now, suppose I am a trust. In the first year, I have only written the trust deed. I have collected money and put, say, 10,000 rupees in a bank account. I have done nothing more. So I have no activities. I may be doing some activities, but the level of activities is so less or so small that the trust has not applied for registration and it would not make much of a difference. If in the subsequent year the activities really start, the trust can directly apply for a regular registration. So it is not important, or it is not you. So a new trust can actually plan the year in which they are starting their activities and the year in which they are applying for the registration. It need not be in this very same year. So that is one point to be borne in mind. Second is, for a trust, once it has started the activities and it applies for registration. So let us say there is a trust which existed 10 years ago, never applied for registration under the Income Tax Act. Whatever was the money, whatever was the income was either taxed, or it had certain, say, a school which had a fees of less than 5 crores of rupees, and therefore it was claiming itself to be exempt under 1023C4 AD, assuming a situation like that. In that case, if it now goes in for registration, it can directly apply for because the activities have already commenced, it could go in for a regular registration. So the law is now basis whether your activities have commenced or your activities have not commenced. If the activities are commenced, you apply for a permanent registration, or if the activities are yet to commence, the trust can apply for a provisional registration. The permanent registration or a regular registration is valid for a period of 5 years, and a provisional registration is valid for a period of 3 years. Now, friends, this section 12A contained the subsection 2 had 3 very important provisos, second, third, and fourth provisos. Now, when all these amendments took place in section 12A, these provisos got deleted. They were omitted. Now, amongst these 3 provisos, the second proviso is very important. It said that where registration has been granted to the trust or institution under section 12AA or 12AB, then the provisions of section 11 and section 12 shall apply in respect of any income derived from the property held under trust of any assessment year preceding the aforesaid assessment year. So let us say I have applied, I started my activities, as I said, in 2015, and the trust forgot to apply for registration. It applied in, say, in 2019 for registration, and it is granted registration. In meantime, there is a preceding year, say assessment year 16-17, which has come up for scrutiny assessment. The assessing officer finds that I'm not a registered trust, and I'm denied the exemption under section 11, rightfully so. And in that case, he has imposed the applicable taxes on me. But subsequently, I have been registered under Section 12A, and I'm entitled to to the exemption under Section 11. Then the rollback provisions was that this exemption which I've got in a subsequent year will also be available for a preceding year. If if it is under different stages of assessments. If, say, it is still in appeal, that exemption can still be rolled back to the earlier years. So this was a very beneficial provision brought in by Finance Act 2014 that, okay, if you are a trust, you have not registered yourself. Today you come and get yourself registered, and you find that there has been no change in your manner of your operations in the last earlier years. So if you are eligible for exemption this year, you're also eligible for exemption for the previous years. So that was the beneficial provision under this second proviso. And unfortunately, this has now been omitted. Now, as I said earlier, under 12A, the last year they have brought in the provisions relating to condonation of delay. But that condonation of delay will be applicable for the application submitted after 1/4/21. So if I was to apply by 30th of June 24 and I applied in, say, 30th of June 2025, my delay can be condoned. But this will not condone the delay of not getting registered before 21. So the benefit of rollback provision which was there is now taken away, and this is another area of harshness, more particularly for smaller trusts. I'm sure the larger institutions, schools, colleges, hospitals, which are run as a not-for-profit organizations, with the benefit of people like us, would have ensured compliances on timely basis. I'm more worried for the smaller trusts, which may have which have not complied with these requirements so far and may have a taxable income in the earlier years. And therefore, this 12A to this second proviso, I strongly feel should be brought back on the statute book. But as we will see that even this has been subject matter of litigation. So the consequences of this could be, if I'm not a registered, even if a trust gets a corpus donation, that corpus donation is an income under Section 56(2)(10) if that trust is not registered under Section 12A. So that registration is very important. Otherwise, the income which is coming to that trust, even as a corpus donation, and we have this case of Rasipuram Rotary Club Trust from Chennai, where the trust had to, where it said that even corpus donations in cases of unregistered trust could be liable for taxation. This was in terms of the earlier provisions of 56(2)(5), which today are in 56(2)(10). So it could be income under the head income from other sources. Now, the provisions with respect to this aspect of the second proviso, there are decided cases of tribunal from Ahmedabad, from the Ahmedabad tribunal, and similar decisions also from Indore tribunal, and few more tribunals have followed the Ahmedabad tribunal decision, that if there are assessment proceedings which are pending, those assessments can get the benefit of this rollback provisions. And if a registration is granted in the subsequent year, that benefit would also be available in the earlier years. So this case of Ahmedabad Tribunal is today very important. It is, as I understand, it is now before the Honorable Gujarat High Court. It is being tested before the Honorable Gujarat High Court. And to the best of my knowledge, the decision of Gujarat High Court has not come in so far on this case law. Now, why this is important is because there is a completely different decision from the Honorable Allahabad High Court. And Allahabad High Court has said that the way the second proviso is there, it negates the original section. And therefore, that second proviso is overriding the section, which a proviso cannot override the main section. The exception through a proviso cannot negate the contents of the contents in the main section. And on that ground, the benefit under this proviso was not granted by the Honorable Allahabad High Court in terms of decision of Shiv Kumar Sumitra Devi Smarak Shikshan Sansthan. Now, once there is a decision of a Honorable High Court and there is no decision of the jurisdictional High Court, then the decision of the High Court will apply in relation to a decision of a favorable decision of an Honorable Tribunal, because that is the judicial hierarchy. But if the Ahmedabad Tribunal decision is confirmed by Gujarat High Court, then on that issue there will be two High Court decisions. And if, assuming Gujarat High Court appeals the tribunal decision, then there would be one High Court in favor of the SSC and one High Court in favor of the department. In meantime, today, SLP filed by the SSC before the Honorable Supreme Court was withdrawn. I don't know why it was withdrawn, but it is reported as having been withdrawn. And therefore, the decision of the Honorable High Court in that context is confirmed by the Honorable Supreme Court. So it is very important that the matter which is pending before the Honorable Gujarat High Court is decided in favor of the SSC. And then the matter can still be litigated before the Honorable Supreme Court, and one can look at, see what the decision is. Having said that, that second proviso stands omitted today. And unless the benefit of that second proviso is brought back, that benefit would not be available. And I think this was a good amendment which was carried out in 2014 and which should still continue to be available to the charitable trusts. Friends, in the next couple of the slides, I have tried to summarize the timelines and procedures for registration. I would not take much of your time on these aspects. These are procedural aspects. Suffice to say that existing trusts must have got themselves registered by 30th of June 2024. Otherwise, they can apply for registration with an application for condonation of delay. New trusts, if their activities have commenced, they have to they can apply for a regular registration. Trusts which have not commenced their activities can apply for a provisional registration, and provisional registration is initially granted for a period of 3 years, and then it is subject to a regular registration which is there for a period of 5 years. Now, the procedure relating to cancellation of registration is also prescribed under section 12AB subsection 4, and the principal commissioner and commissioners of income tax have been given powers to carry out the procedure. If the assessing officer during the course of assessment finds that there have been violations in terms of compliances with the provisions of the law, can recommend to the commissioner income tax. Commissioner income tax can also, having noticed any defaults, can also take up the matters, or as per the risk management strategy of the board, certain cases can be picked up for scrutiny and could result in cancellation of registration. The principles of natural justice are prescribed, and before any adverse action is taken, the SSC trust would be given suitable opportunities to bring out why the registration granted should not be cancelled. Now, these are the concept of specified violations which have been brought in the law, and very important for a trust to bear in mind that it should list out what are the material laws for its existence for carrying out its charitable activities. And all those material laws should be scrupulously complied with. Non-compliance with any of these provisions with a material law could result in cancellation of registration. The trust should ensure that it is not giving any undue or unreasonable benefit to its own trustees. It should not be, it should ensure compliance with the investments in the specified modes as prescribed under 11.5. Otherwise, non-compliance with any of these things could result in that being treated as a specified violation, leading to the cancellation of the trust. Then, friends, let us move on towards the application part. Now, as I said in the very first slide, which I was taking up, that the application should be out of the income of that particular year. The application should not be in the form of should not come from borrowings or from your corpus or your brought forward losses, etc. Similarly, the application can be by way of a voluntary contribution to another trust, which is having a similar objects. So if I am a trust and my objects is to help people, say poor people in India. Now there is another trust carrying out similar activities. I am say based in Madhya Pradesh. I come across a trust carrying out similar activities, let us say in Telangana, and I decide to give certain contribution to that trust which has objects similar as my objects. The object should be similar because I, as a trust, am required to apply my money, my income towards my objects, to the objects which I have declared. So if my objects is to help the poor, relief to the poor, and I come across another trust which is also having objects of relief to the poor, then I can give a voluntary contribution to that trust. But assuming its objects are for the purposes of, let us say its objects are education, my objects are relief to the poor, then the issue would arise that I have not applied my income towards my objects for which I have been formed. So while deciding the objects, normally the trust deed would contain all these clauses: relief to the poor, yoga, education, medical help. All these clauses would be covered as defined under section 215. But care must be taken to see that the trust to which the donation is being given is one for a voluntary contribution. It is not towards the corpus of that trust. If I give a donation to the corpus of that trust, then it is hit by this first clause that any donations to the corpus of the trust would not be considered as application. So it has to be as a voluntary contribution other than corpus of the trust, and the trust should have similar objects as what objects I have. Then we have this provisions contained in section 40A 1A. 40A 1A and 40A 3. 40A 3 is that cash payments cannot exceed 10,000 rupees. And 40A 1A is disallowances if the tax is not deducted at source in respect of certain payments which are prescribed in that section. So it is rent, payment to contractors, commission, etc., on which tax is required to be deducted. If not deducted, there is a disallowance. Now, 40A is covered under the head income from business. And charitable trust is not being, the income of the charitable trust is not being computed under the head income from business and profession. Therefore, by way of an explanation under section 11, the provisions of 40A 1A and 40A 3 have been mutatis mutandis applied to the provisions of a trust. So while determining the application amount, if tax is not deducted at source or if payments are made in excess of the prescribed limit of 10,000, then to that extent, the deduction, that amount will not be considered as an application of income. Now, the ITR 7 for the current year is yet to be notified. The ITR 7, which was there for the last year, assessment year 24-25, had a very structural defect. And in one of the cases of one of my client cases, an application had to be submitted to the Commissioner Income Tax, which is yet to be disposed of, pointing out that ITR 7 for AY 24-25, the way the calculations under ITR 7 were there, actually resulted in a disallowance of application, not just a disallowance, but made that amount taxable at the rate of 30%. So a trust which has not paid which has not deducted tax at source. To that extent, that amount will not be considered as an application. But if I have otherwise spent 85% of my income, even after considering this disallowance, then my income is exempt. And on this disallowance, I'm not liable under the law to pay taxes. But ITR 7 last year had a defect both with respect to the TDS and the provisions of 48.3. And respectfully, I submit that that ITR 7 was not correct. Then the next important part is that the application should come from the income, and application cannot come from the corpus of the trust. So what has now been brought in with effect from 1/4/22 is that if money is spent out of corpus of the trust, or if a money is applied from loans and borrowings, then they will not be considered as application in the year in which it is actually spent. But within 5 years, if I reinvest in the corpus, or within 5 years I repay that borrowings, then to the extent it is reinvested in the corpus, or to the extent the borrowings are repaid, that would be considered as an application of income. So the year in which I spend the money towards the objects of the trust, that year I will not get benefit because it is not coming from my income, but it is coming from corpus, or it is coming from loans and borrowings. But within 5 years, initially this period of 5 years was not there. It was brought in, I think, in 23 with effect from 1/4/21, that the corpus should again, if the money used from corpus should again be reinvested or redeposited in the corpus, or the borrowings should be repaid, and that would constitute an application of income. Then in case of trusts, this is again a new provision which has come in a couple of years back, that if I give a, say, donation of 1 lakh of rupees to a trust, that trust is required to spend 85,000 rupees towards its objects of the trust. Whereas I have considered 1 lakh as an application, the actual application is in the hands of the trust is required only to the extent of 85,000. So to ensure that the trusts are encouraged to properly use that money for the ultimate benefit for which the trusts are created, this kind of a provision is brought in, that because the trust is required to spend only 85% minimum, the benefit of deduction in my hands is also restricted to 85%. So the donations to another trusts, one, the object should be similar. Second, it should not be to the corpus of the trust. It should be a voluntary contribution in the hands of the trust. And out of the amount donated, only 85% will be considered as application in my hands. Then, as I said, no set-off for deductions or allowances for brought forward losses. Amount actually paid would be considered as application. No benefit can be given to any of the specified persons under Section 13. Unreasonable benefits cannot be given. So if they are availing the medical facilities, or if the children of the trustees are studying in the educational institutions, they should also pay the same charges or fees as are being paid by others. Then application should be in India. Now, this is one area where we'll have some deliberations, because this is one important provision, that the purpose should be in India and the money spent should also be in India. So just a small illustration to explain the concept of reinvestment in the corpus. If I received 100 as a donation towards corpus and invested in a FD, mode specified under 11(5), out of that 25 I've used for purchase of a capital asset, it will not be considered as application. But the year in which I replenish that 25 back into the corpus, it will be considered as an application. And these changes have become effective from assessment year 23-24. Then donations to the trusts, how the trust is utilizing the money is not my responsibility. My responsibility as a donor is to ensure that their trust, their objects and my objects are similar. Thereafter, the manner in which they are using the money, how they are spending it, is not the responsibility of the donor trust. In terms of 11.1c and 11.1a, to the extent that it requires deduction of, it requires that the money should be applied in India for a purpose in India. Now, assuming you carry out, so there is a decision of Honorable Delhi High Court in case of DIT versus NASCOM, reported as 345 ITR 362, where the Honorable Delhi High Court has held that money spent by NASCOM, that is National Association of Computer Manufacturers, in the Hanover projects, Hanover trade fairs in Germany, was found to be an application of income outside India. And therefore, it was hit by the provisions of 11.1a, which requires income to be applied for such purposes in India. The case of the SSE is my purpose is in India, but I have spent this money outside India. Now, if this case law is extended in context of, then there is this decision of Honorable Delhi High Court, Delhi Tribunal, in the cases of India Brand Equity Foundation, where Honorable Delhi Tribunal followed the decision of the jurisdictional High Court and held that if the money is spent by the SSE Trust for a fair in Germany, it said that that part would not be considered as an expenditure for a purpose in India. So, while it may not be right to say that all foreign expenditure are expenses outside India and therefore are not an application of the purposes in India, but what and how that money is being spent is very important if the expenditure is being incurred overseas. Then, friends, accumulation of income, these are well defined and well understood provisions. Under section 11.1, there are two modes available for accumulation of income. One is if the income has accrued but not received by me. And second is for some other purposes, I have not been able to utilize the money to the extent of 85%. In both the cases, I can file Form 9A before the due date of filing of return of income, and thereby have this income not being considered as income for that particular year. So suppose I have kept money in a fixed deposit, and my fixed deposit, the interest on the fixed deposit is accrued on a year-to-year basis. Now, I have not received any interest. The trust has not received any interest on that deposit. The interest has accrued, but it has been reinvested in that fixed deposit. Now, it is an income of which I should have spent 85%. But since I have not got anything in my hands, I can file Form 9A, and the year in which that amount is realized in that year or a year in the next year, if I can spend that money at least to the extent of 85%, then it would be considered as an application. So 11.1 has these two provisions where the income has accrued and not received, or for any other purpose you have not been able to spend it in that year. So as I said at the time earlier, as I said, that the surplus is required to be invested in a mode prescribed in 11.5. I find that my fixed deposits are less, and my 15% accumulation I will not be able to demonstrate that I have invested that in a fixed deposit. Then one of the ways of getting out of the situation is to use the second provision under this 11.1 explanation, that for any other purpose, I can accumulate it for 1 year. and therefore it will come out of my total of my income for that year. And therefore, to the extent of 15% of that, my deposits, which are not in fixed deposits or modes prescribed under 11.5, I can get out of that trouble. So 9A is the form, but important is that it should be filed before the due date of filing of the return of income. Then accumulation of income for a period of 5 years is permissible under section 11, subsection 2, and correspondingly under the third proviso to 1023C. The form 10 is the form which is prescribed and which is required to be filed 2 months in advance. So the due date for assessment year 25-26 is actually 31st of August to file form 10. But there is a board circular which says that if it is filed up to the due date of filing of return of income, that will not disentitle the accumulation in the hands of the trust. So that's a beneficial provision, but the actual due date for filing form 10 still remains 31st of August. Then the accumulation, as I said, is for a period of 5 years. Earlier, it was 5 years plus 1 more year. There was a disjoint between the provisions of 11.2 and 1023C third proviso. 11.2 provided that if the money is accumulated for 5 years, and in the 6th year, if it is not applied, then in the 7th year, it would become taxable. So the window was for 5 plus 1, 6 years, whereas under third proviso to 1023C, it was 5 years. Now it is harmonized in both the cases and it is made uniform 5 years. So within 5 years, it needs to be applied. Then what should be the objects for which the accumulation can take place? It can be for any objects for which the trust is formed. And while it is desirable that the specific objects should be mentioned, there is no legal requirement that the exact object should be specified. And therefore, there are beneficial decisions to that effect that so long as the accumulation is for the purposes of objects of the trust, the accumulation is permissible. And in one of the cases, it was also found that a notice which was given in 1 year, which covered the next year also. And in the subsequent year, if a separate notice was not filed, it was held that the first notice filed in the earlier year would also cover the subsequent year. Now, while these are very technical matters and benefits to be taken only when in a very difficult and tight situation, as a normal prudence, it is imperative that the notice should be filed every year before the prescribed due date, as far as possible, even 2 months before the filing of the due date, prescribed due date, which is 31st August. But in a remote situation, these are cases which could help the SEC. And it is possible to change the objects for which the accumulation is done with the permission of the AO. Then the accumulation which is done could become taxable if it is not utilized for the purposes for which it was accumulated, or if the investment is not continued to be made in the modes specified under 11.5, or for any other such reasons, then it would become taxable in the year in which that default would take place. Then friends, anonymous donations. So Vinodji, while I have a few more slides and few more topics to take up, but it is while we are reaching end point, I will stop after 5 minutes. By say 6:50, I'll stop my presentation.
Very nice.
And if there are any specific questions, we can take them up. Otherwise, this is really a large topic and we can keep discussing for many, many hours.
Yes.
Anonymous donations is where donations either up to 1 lakh of rupees are not considered as anonymous donations, and more than 1 lakh of rupees, but less than 5% of the total receipts. these are outside the thresholds of anonymous donations. Anonymous donations means donations from unknown persons. So what is today required is the name and address of the donor should be available. PAN, Aadhaar, those details are not prescribed so far. So the trust should have name and address of the donor. If the name and address is not there, then it would be considered as an anonymous donations. And on that anonymous donations, tax at the rate 30% would be payable. Now, many times the trusts may get donations from people using UPI apps. And there are multiple apps on which the donations, the online transactions can take place. Today, the government has encouraged online transactions. And if there is an online transaction, then 48(3) would not apply, 269 SS and T would not apply, because it is an online transaction and those transactions are encouraged. But in many of the UPI transactions, and particularly for smaller amounts, it is not known from whom that money has come. In many cases, it happens that your bank may not be able to tell you who has given that credit to you. And many of us would have seen that there are items pending for reconciliation in the bank statements because the exact person from whom, there's a sales realization, but from which customer that money has come in is not known. So what is required here is name and address should be mentioned. Now, I would again request DTC to take up this matter that if there is an online transaction and in such a case, if name is not available with the trust, then it should not be treated as an anonymous donation. Because there is a technical mechanism available with the banks to go back to the source of the transaction and find out from which bank account this money has originated. And once it can be traced to a particular bank account, every bank account is linked with a PAN, or there is a Form 60 declaration. For people who do not have PAN, have to give a Form 60 declaration in Form 60 before a bank account can be opened. So once it is coming from a bank account, the name, address, and KYC details are available with a bank which has done from where the money has originated. And therefore, for the purposes of anonymous donations, online transactions should not be considered as anonymous donations in cases where uh, the money has come in through using UPI apps, etc. Otherwise, anonymous donations received by a religious trust are exempt, or a temple can have a box outside its in the temple premises where money is put in, and that money will be anonymous because nobody knows who has given how much contribution. But religious establishments, religious trusts, to them the anonymous donations would not apply. If it is a trust which is carrying out both religious and charitable activities, there should be no anonymous donations specifically for the purposes of the educational or hospital activities of that trust. If it is for educational activities or hospital activities carried out by a religious trust, that is a trust which has both, which is religious as well as carrying out charitable activities. If the donation is for its religious purposes, then the anonymous donation is exempt. But if it is for the charitable purposes, for carrying out the further activities relating to the educational institution, medical institution, hospitals, then it would be an anonymous donations and it would be taxed. If it is received by any other charitable institution, then anonymous donation is liable to be taxed at 30%. Now, friends, if an anonymous donation is received by a trust which is not registered, then this provision will not apply. Then 56(2)(10) would apply. And that money would be taxed in the hands of any other of an unregistered trust as income from other sources. and subject to the other deductions, etc. It can be, or other set off as permissible under the law, it can be adjusted. But in the hands of a registered trust, it cannot receive anonymous donations. The ceiling is 1 lakh of rupees or up to 5% of its gross receipts. Then the return of income should be filed within the prescribed time period. Otherwise, the trust can lose its exemption status. Documents which are prescribed in terms of Rule 17 AA, very important to be seen that proper details are maintained in accordance with the requirements of the Rule 17 AA, and this is also one of the areas for the audit under 10B and 10 BB. Books are required to be kept at the registered office. This is again something new which has come in. Normally, we have the concept of registered office in context of companies. But even non-profit organizations will have to determine what is their registered office. Generally, the address where the PAN is situated is the registered office or the main office of a SSE. Now, the books of accounts should be kept at that place. If the books of accounts are kept at any other place, then the assessing officer is to be intimated within 7 days of keeping the books of accounts at other place. And this is something which is important and should be properly ensured to be complied with. Books are required to be maintained for 10 years or longer time period if the assessments of the earlier years have by chance been opened under the relevant provisions. Then payment to specified persons, I have already discussed. Penalty provisions are harsh. For the first time penalty, it is 100%. Subsequent penalties could be 200%. Then 115 BBI is the consequence of non-compliance, and it would be the income would be taxed at straight away at 30%, subject to, and no other adjustments, allowances would be available in terms of this income. Voluntary contributions for renovations and repairs of temples, mosques, gurudwaras, churches, etc. These are even voluntary contributions under Section 11 explanation 3 or 4. It can be explanation 4 and 4A. It can be considered as a corpus donations, and it can be the benefit of Section 11 1D can be taken for that. Then finally, friends, as I close my presentation, the two very important decisions which I would like to draw your kind attention. As I said earlier, Ahmedabad Urban Development Authority, for the purposes of any trust which has advancement of general public utility as an object, we as auditors, consultants should familiarize ourselves with what has been held by the Honorable Supreme Court. And for those who are auditing the cases of educational institutions, the decision in the case of New Noble Educational Society is a landmark decision, and it could have an impact on the final assessment and the taxable tax position of the SSE. So Vinodji, with this, I'll stop here. If there are any questions, I'll be happy to try and answer them to the best of my abilities. I thought the chairman would be available and the vice chairman would be available to help me out. But as they mentioned, they would be in flight at this point of time. So to the best of my ability, I'll try and answer those questions.
So I'll merge few questions so that we may take up maximum questions. So, sir, I'm merging three such questions. One is whether very small charitable organization, charitable trust, they need to take registrations under income tax laws, and if they are not registered under, then second main question I'm adding is if they are not registered under Section 12A, whether basic exemption is available or they need to pay tax at MMR rates. And the third question is if any charitable trust is paying tax at MMR, whether this surcharge is applicable, and if applicable, at what rate?
So, in case of a charitable trust, any trust, if it is not registered. Registration is not mandatory. Registration is a prerequisite income. Now, if the income itself is so small, say the investment, the trust is having, say, 10,000 rupees as the trust, the original trust amount, and that is kept in a fixed deposit in a bank. Now you are getting 1,000 rupees or less than 1,000 rupees as interest. You might not bother to pay 300 rupees as tax on that and be done away with all other compliances. So registration is not mandatory. Registration is mandatory if you want to take exemptions under the Income Tax Act. So that is one part. So small trusts can decide, basis the quantum of money involved, whether to take the registration or not take the registration and pay the taxes. The second question is, if it is an association of persons, at what rate it should be taxed and whether it would be available, the basic exemption limits would be available. Now, it depends on the position of the trustees. What is their position? If any one of them is having a taxable income, then this will not get the benefit of the basic exemption. The trust will not get the benefit of the basic exemption. And today, the taxable income being, the thresholds being so low as such. So it is quite common to see that the trustees would have taxable income. Otherwise, if the trustees do not have taxable income and they do not have deep pockets, it's not conceivable that they can they can be trustees in a charitable trust and carry out charitable activities. So invariably, the trustees would have taxable income. Therefore, the trust should pay tax at the rate of 30%.
And sir, MMR and surcharge rate.
So whatever is the applicable surcharge would be there.
Yes.
Cess at the rate of 4% would be payable.
So now another question is, how to set up a corpus fund in a charitable trust?
Okay. So the trust can receive donations towards the corpus of the trust. It is better to take a declaration from the donor that this money is towards the corpus of the trust. Signed letter is good enough evidence that I am giving donation to this trust, which is meant for the corpus of the trust. An issue had also come up that if the money invested in the corpus of the trust is invested by that trust in a, say, fixed deposit, the interest on that fixed deposit, is it part of the corpus or is it part of the income? Many times, what is done in fund accounting, typical in fund accounting, and as I said earlier, because for the not-for-profit organizations, there is a separate technical guide which is made applicable by the institute, which we are required to ensure compliance. In a fund accounting, normally what is done is the interest on the deposit is credited to that fund. It is not routed through income and expenditure account. Actually, it should be routed through the income and expenditure account, and through the appropriation, again, it can be appropriated towards that fixed deposit. So that is the accounting part of it. Now, what is the tax part of it? The donor should have given a declaration that I am giving this 10,000 rupees to the corpus of the trust, and the interest earned on that corpus will also be invested in the corpus of the trust. If that declaration is so clear and enabling the trustees to see that the original donation and the interest thereon are directly supposed to go to the corpus of the trust, then the interest will also be exempt because it will be part of the corpus. But if the idea is that the interest earned on the fixed deposit is to be used for the charitable activities, then that interest will not be considered as corpus. It will be considered as income out of properties held under trust, taxable under section 11(1)(a).
So there is another question. An educational society whose income is eligible for exemption under section 1023C 3 ED is getting rents on property which is let out to state government for residential courses. Is this rental income exempt under the above section?
I mean, see, it is an educational institution, you said. You are registered under 1023C6. As I said, please see the decision of New Noble first. Because New Noble says that when you are registered under 1023C6, it should be solely for education. So that is the first warning point that I want to draw attention to the querist. If you are being, you need to analyze whether you are being hit by this Supreme Court decision or not. I cannot really answer that because that requires a examination of the case with respect to that decision, which I have given that decision. I would request the learned queries to go through that decision. Assuming you are within the, you are still charitable because that is just an incidental item, not the main business. You have, say, like for educational institutions, there could be fees, say bus fees. There could be a mess fees. No, these are activities which are in the essential for running that school. If the students are to be in the school for 5 to 6 hours, they have to be provided meals during the day. And for those meals, they have to be, the school has to be compensated. Now, whether it is a normal activity or a commercial activity will have to be gone into. If the fees is reasonable to the expenditure which is being incurred, but if the fees is also a source of income, the bus fees is also a source of income, in that case, the institution may not be running solely for education. So very finely, each case will have to be analyzed in light of that New Noble decision.
But sir, here the property is related to
Assuming,
state government, yes.
now, assuming in the case which is put up, I am quite conscious that we are at the end of our time, so I'll just quickly wrap up this question. But it is important to note that if it is still being within the solely for education, there is incidental income which is coming in, then you can claim exemption for that, subject to the other provisions of the other relevant provisions that 85% is being spent, etc., towards the objects of the trust.
So then another question is, if any depreciable assets are purchased out of application of income, whether depreciation is allowed on such assets?
So this is now a well-settled position. Prior to 2015, the law was different. The law allowed double deduction, so to say, that the year in which the capital asset is purchased, it was considered as an application of income, and in the subsequent year, even depreciation on that asset was being claimed. So the deduction was being claimed twice. Once when the asset is purchased and subsequently depreciation over the life of the asset. Now the law has been amended. Way back in 2015, I think assessment year 16-17 onwards, the law has changed. And now double deduction is not possible. So if you have claimed that capital asset as an application of income, then on that you cannot again claim depreciation. But if you have not claimed that asset as application, then you can claim depreciation on that asset. So this is where your planning is important. If you have already spent 85% of your income in the manner in which it is required to be computed, then you should not show acquisition of capital assets again as an application of the income of that year. Then you have a problem. Your problem would be that if you do that, if your expenditure is more than 100%, that excess will not be allowed in this year or in the subsequent years. And also to that extent, you will lose the benefit of depreciation in the subsequent years. So let that 15% surplus be available with you rather than exhausting it completely 100%.
Thank you, sir. Now, another question is, without considering the threshold limit, the CPC is processing the returns by raising the tax demand for assessment year 24-25, and CPC is not considering the 154 petitions also. What is the alternative except the CIT appeals? Kindly guide.
I mean, these are practical difficulties. So there are multiple cases which could be pending for different reasons. So I have one case where the learned jurisdictional officer, I have moved an application under 154 for a rectification of a mistake apparent from records in a 143.3 order. And the appeal which is required to be filed within 30 days, the application under 154 is not cleared so soon. So the application is filed and an appeal is also filed. Now the appeal is still pending and the jurisdictional assessing officer says that because your appeal is pending, I will not entertain 154. Although I don't think that is the right procedure because 154 does not prohibit you from, it does not say that if you have filed an appeal, that mistake cannot be rectified by the assessing officer. Now, be that as may, these are practical difficulties and you will have to pursue all your legal remedies which are available to you.
So another question is, a society operating as school as not a profit organization was granted certificate of exemption under section 1023(6) as its receipts exceeded 1 crore. Then later, after enhancement of the limit from 1 crore to 5 crore, it should be eligible to claim exemption under 1023(c) 3AD. Due to oversight in the first year of transition, pre-filled data was fetched in ITR filing utility and the section remained 1023(c)(6). The CPC denied exemption and taxed entire receipts. What are the remedies available?
See, the taxation is always of the real income. So if there are such anomalies which are happening because of mismatch between what we understand and what CPC is understanding, does not mean that the processing by CPC would be the right thing. There are multiple cases where you go to the CIT appeals or go to the ITAT and you will definitely get the relief.
So though we have many more questions, due to positive time, if you permit, I can take up the last question.
Sure.
One member has asked whether there is any change in taxation of trust in the old regime and in the new regime.
No, there are multiple changes which I have discussed. I mean, what I have discussed in my presentation are the significant important amendments which have taken place in last few years. And as the law is applicable for assessment year 25-26.
So though we have many more questions pending, but due to positive time, and as you already said, it is such a detailed, it is a large topic that we cannot take all the questions. So if the DTC secretariat or DTC permit, then I can take a few more questions, or else we can.
You may
put the
take up one more question and then let's make it the last question. And my presentation would be shared with DTC and they would make arrangements to host it. But yes, in a webinar like this, we cannot solve all the questions.
Yes. So the last question is, sir, this has been asked by so many members that whether the format that has been issued by the ICAI for not this non-corporate SSE is applicable to the trust also.
I would request members to please see the FAQs issued by ASB and AASB. It is jointly issued by ASB and AASB, wherein it is clarified that the format for non-corporate entities will not apply for NPOs because there is a separate technical guide which says what should be the format for NPOs, not for profit organizations. And that format would be the one which is to be applied for the purposes of all charitable trusts, institutions, and others. Now, mind well, as I said earlier, and I think I touched upon this in the beginning, that format is also a complicated format because it makes you identify what is fund, what is specific funds, what are restricted funds, what are unrestricted funds, and basis that you draw up the income and expenditure account and balance sheet. In many cases, on a lighter side, one may say that the format for the non-corporate entity is easier to apply for a charitable, for an educational institution rather than going for that NPO format. Of course, that was only in lighter vein, but because there is a separate format and we being chartered accountants, it is only a matter of spending a couple of hours on the subject and we can master that format. So the format which is prescribed for NPOs is different and that format should be used this year. Not the format for non-corporate entities and certainly not the format which we were using in the earlier years.
So last question from me.
Yes.
Sir, we are auditors to one of the ULBs, and the gross receipt of the ULB, other than from one of the trading business they do, is 150 crores. Maybe say like property tax collection or collection from user fees or charges. And they also own a petrol pump in the heart of the city, and the turnover of that particular petrol pump is around 225 crores. So whether provision, proviso of section 215 apply to that, because the gross receipts are more than 20%.
So if it is claiming its income as exempt under section 215 as a charitable purpose, uh, then you will have to see under which limb of 215, which is the charitable activity which is carrying out. If it is falling in the last activity, any other objects of general public utility, and it is carrying on trade, commerce, or business, if it is for a fee, cess, or a duty, now obviously you will come under that definition. You said you are an urban local body running a petrol pump, so you are definitely carrying on a trade, commerce, or business. Now, if your receipts from petrol pump are exceeding 20% of the total receipts, then you will be hit by that provisions of the proviso to 215. In light of the decision of the Supreme Court in case of Ahmedabad Urban Authority or Ahmedabad Development Authority, you need to examine your case more closely. But yes, I feel if you are exceeding 20%, you may be hit, your client may be hit by those provisions.
Because the surpluses are anyways invested in this sewerage treatment or providing electricity to, but yes, the provision, plain reading of the section is a.
And there is one decision which I have covered. There is in my presentation, as I showed, servants of society or servant society, some such name, and it actually says that the matter related to a press started by Lala Lajpat Rai, one of the greatest freedom fighters of our country. That press was to that society, a press was donated, and it was carrying out printing press business. Now, the printing press business activity resulted in 20%, the receipts from printing press were more than 20% of the total receipts. And the court has held that the law is clear. If your receipts are more than 20% of your gross receipts, and you are in the business, you are carrying out a charitable purpose, which is advancement of general public utility, then you are hit.
Okay.
If you are carrying out an educational business, educational activities, and you are running a printing press, which is incidental to the educational activity, then you are not required to see whether it is 20% or less than 20%. The 20% proviso is only with respect to any other object of general public utility, GPU. So please see the facts of your case in light of the Supreme Court decision in case of Ahmedabad Development Authority.
Thank you so much, sir. Sir, at the outset, we are really very much thankful to you for so insightful and detailed presentation on taxable of charitable organizations. And I must say that you already knew what kind of questions may crop up, and you already deliberated all that. That means you already addressed those questions in your deliberations. So you made my task easy of taking up the questions. So we are very much thankful. And your deliberations on section 11.5 to 15, registrations, cancellations of registrations, 12A, section 12A. I mean, they were all very much in depth. I personally do not practice in this particular space, but I'll tell you frankly, sir, I have gained a lot of insight from your deliberations, and I can now rest assured. That means if someone comes to me, I can definitely counsel them immediately and impromptu. So thank you so much, sir, for sparing your time. We are also thankful to all the attendees for their careful attention and their registration and enrollment. We are thankful to the DTC chairman, vice chairman, sir, and the entire team for organizing such a well-planned and hot topic which is
Thank
being
you,
very
Vinodji.
beneficial
Thank
for the
you.
interest of our members.
You have been very charitable in your compliments to me. But
No,
I'm
sir, it
also
was a very
yeah, I'm
insightful
thankful
session.
to
Thank you
you.
so much for the
Yeah,
sparing your
thank
time,
you,
sir. Thank you very
Madam
much.
Priya. You have been a great help to the DTC all the last 20-25 years. I know how hard work you have been putting in. So thank you very much, and thanks to
Thank
Mr.
you,
Ravi
sir.
Gupta for all the coordinations.
Thank you, sir.